Before we start, I would like to introduce the CICT team here today. We have Tony, our CEO, Mei Lian, our CFO, Jacqueline, our Head of Investment, Yichuan, our Head of Portfolio Management, Mei Ping, our Head of Investor Relations, and I'm Clarice, part of the IR team. Together from our team are Alice and Satish. Now I'd like to invite Tony to share his opening remarks. Tony, please.
So good morning, everyone. Thanks for tuning in. Hope you had a good long weekend. As you probably have digested, last Friday we released our third quarter operating update. Just some short remarks. I suppose over the weekends and perhaps a little bit time this morning, you may have time to digest the info. And after following my short remarks, I think we can go straight to Q&A. So third quarter, I don't think anything very surprising. It's just continuation of the impact from the reopening, further relaxation that we've seen at the end of, in fact, from the beginning of May, end April, May, and with further relaxation on, especially on the mask mandate. We certainly see an uptick in activity, both in the retail side and in the office side. So that translates into the relatively strong operating metrics that you see on screen here, with of course coupled with the lower base that we see from third quarter last year. We've seen a very nice rebound in traffic number in the retail side as well as the sales side. Things to point to note that we have seen not unsurprisingly, a much stronger rebound from the downtown mall compared to suburban mall, given where they have been impacted more compared to the suburban. But also importantly, some of the things that have been underpinning the strong rebound from in downtown mall, things like the more people returning to work, you get more further relaxation in the border, and you get more influx of business traveler, tourists. At the same time, I think the general sentiment has been pretty positive on the ground, and we've seen people flocking back to the mall, and hence you see a nice trading upward. I mean, following that, obviously the office space I think has been also gaining some traction, as you've seen from our occupancy with backfill, especially Capital Tower. Majority of the space that's been vacated by JP Morgan, the anchor space, with the remaining that was already in a different stage of documentation or negotiation. So we are generally positive in our office portfolio towards the end of the year. Similarly, I think we are relatively positive as well for the retail space towards the end of the year. Of course, I think everyone's mind is the general macro outlook. That's no different from us. Notwithstanding I think a strong fundamental underpinning Singapore position vis-a-vis a regional country or around the world. We do know that the headwinds are potentially coming, especially on the cost side, energy side, as well as the interest rate side, that will affect both the interest costs as well as the operating OPEX as well. But we're trying to manage that as best as possible. We enter into this storm in January in a pretty good shape. Our balance sheet has been quite robust, with a fairly conservative capital management strategy that we have undertaken for years, that now we are seeing that being able to play out in the market, and the way that we are able to more nimble to maneuver according to things that happen in the marketplace. So I think that gives us a little bit of lever to look at how we could better manage and navigate through such a volatile environment. I think with that, I will just pause here, and then we can go straight to Q&A. Yeah.
Thanks, Tony. Before we start the Q&A, please take note of the following instructions. If you have any questions, please click on the raise hand button. When your name is called, please unmute yourself and ask the question. If you can, please switch on your video feed as well. Alternatively, you can type in your questions via the chat function. Okay, I see you have a few raised hands. Donald, please go ahead.
Hey, hi, Tony. This is Donald.
Hi, Donald. Hi.
Can you hear me?
Yeah.
Hi. A couple of quick questions. First is, given the continuous turnaround in the retail reversions and tenant sales, where is occupancy cost at this point? And how does this compare to pre-pandemic? This is my first question.
Okay, so I think it's tracking fairly in line with what we see even pre-pandemic. And of course, you're looking at it more from a portfolio perspective. January has still been quite healthy within the range of high 17% to, as a portfolio, to about 20%. And within that, obviously, some of the properties are probably trading at lower end. This all depends on the construct of your trade exposure. But I think we are in a good shape. Yeah, about 17% lower end.
Thank you. So 17%, that's still below, pretty much below pre-pandemic, right? Where we went as high as 19, 20%. Would you say that? Would you say that there is some scope for rent growth, at least in the next couple of quarters?
Yeah, that's certainly something we're pricing. We probably have seen on the sequential basis, the rental reversion has been improving. More so for suburban, but even true for these downtown mall. Now that we've seen a little bit of revival in the downtown. In fact, downtown mall we are tracking quite closely now. It actually has turned positive as well. Yeah, quarter.
Got it. Thank you. My second question, very quickly, is on Raffles City, the hotels segment, which hasn't really been talked about much. How are the room rates now compared to pre-pandemic, and are we seeing a key driver of revenues coming from this space? Yeah.
Hotel makes up probably about 10 to 12% of the Raffles City contribution. Overall, if you look at what they have published in the website, right, you can more or less have a sense where they have adjusted the room rate. Ballpark, I would say about 2 to 3 times higher than pre-pandemic. Yeah.
Okay, got it. I'll leave the other questions for other people. I'll come back later. Thank you.
Thanks, Donald. Marvin, would you like to ask your question?
Yeah, good morning, Tony and team. I just want to check on the tenant sales for both suburban downtown. How do they compare versus pre-pandemic? I saw this, you disclosed a year-on-year growth. And second question I had would be in terms of the rental reversions going forward. How high can you push? Because obviously tenants were looking at it from both rent plus service charges. And I keep reading about salaries being lifted for their staff as well. So maybe some thoughts on that. Thanks.
Yeah, I think overall the sales been trending well. In fact, even downtown mall up to year to date September is already quite close to 2019 level. It's just marginally very small, 0.1%. In fact, 0.1% at 2019 level. So I think overall the sales has been tracking well. Of course, it's also a function of some CPI link, because obviously the retail price has gone up as well. So they are contributing factor to that. In terms of where we are pricing power, certainly we are trying to adjust vis-a-vis, especially retail, right? As you probably know, we are somewhat constrained by what we can do, from because of the COC that we have agreed upon with the retailers. So even though we may want to look at adjusting the service charge, there are some limitation what we can do. We can only do that for leases that are expiring. So if you do a very broad, back envelope kind of calculation, roughly about 1/3 of our retail space typically will be expiring, and then that's where I think we'll make some adjustment in the service charge. So there potentially can be some coverage, but it's a little bit delayed. But for the broadly for the retail side, part of the arrangement with the retailer group is that for energy costs, obviously they wanted the full pass through, and then that will be in fact that has been already executed, and that will somewhat also mitigate part of the cost that we feel we face in the operation. So there are some mitigating factors that we have to look at it when we look at pricing the rental adjustment. So I don't know whether to recall, I give many examples. I give some examples in a couple of my briefing, right? That for expiring lease, sometimes for existing lease, we certainly can't adjust the rent. So service charge may go up, but you can't adjust the gross rent. And it is what it is, right? For the expiring one, we can look at adjusting the service charge according to the elevated operating cost of the building. That will be applied to the expiring one. So let's say only 1/3 will be able to be affected. So we'll factor that into our adjustment from the renter perspective. Bear in mind that from a retailer perspective, they're only looking at overall the gross rent, right? So if today's gross rent is $10, and that may have component of service charge and the rent component, ultimately they're only looking at the gross rent in the new lease that we sign with them. So we have to factor that in as well, the elevated costs, what you can price into the service charge, and then we look at overall the environment, and we factor that in the rental reversion. And it varies from trade to trade. You know? So some of the tenants are already trading so well. It's a non-event. You adjust it in and you're pricing accordingly. They are still operating in a pretty healthy occupancy cost ratio. So those are, I think, those are easy, low hanging fruit. The more tricky ones are those trades that we still want them to be in. They need to be in for a variety of reasons, and then question is how we're going to price in. So that will always be the trade-off that we have to make adjustment on. But generally, yes, I think there are mechanisms in looking at how we could factor into our rental reversion, including ability to adjust the service charge as well. Yeah.
So just to clarify, the tenant sales as percentage pre-COVID is at pre-COVID levels in September already. And I think from memory, suburban was already above. What will the mix between suburban and downtown?
Yeah. So overall, as a portfolio, we're looking about close to in fact, more than 4% pre-COVID year to date. Downtown, like say quite flat, it's slight negative, minus 0.1%. The suburban, we're looking at 5%. Yeah.
So in terms of there's no clear answer in terms of the rental reversions, but can I presume that it could be remaining around the current rental reversions that you're reporting, some of a flattish for downtown given the service charge impact in terms of total gross rent, and then suburban that maybe 1-ish, 2?
Yeah, I think we started to price in like the question you mentioned, right? Even in fourth quarter, we are looking at leases that will be due in first quarter and all the way up to second quarter, depending on the kind of tenant. So we started to look at pricing in. We should potentially see a further improvement in the numbers in the fourth quarter to be reported. Yeah.
And just finally, maybe some updates in terms of all the expiry of the electricity cost hedges. Have they all started to roll off already?
Yeah, so they'll be rolling off towards the end of the year at the elevated level. But it's not as elevated as current market. So we expect while we look into further hedges, we actually partly locked in part of the energy cost for the first part of next year because we have secured the capacity. I think one of the key concern for many energy consumer would be ability to secure on a bulk basis the energy supply to manage your operation. So I think we have secured that for the next 2 years. Now we are just looking at but then hopefully some moderation on where the Brent price is trading and the dollar cent exchange rate as well. But we're locking part of it in the first half of the year. Expect it to go up further. I think based on the current situation you see in the international market, and I think it's no surprise that the energy costs remain elevated. The natural gas supply remain distorted because of the issue in Europe and the war, and hence I think the volatility in the and the tightness of those important component that goes to producing electricity will still be there unless we see a meaningful either a significant slowdown in growth globally, which will lead to a significant adjustment in the Brent price, or perhaps the end of the war, and then you see a more normalization of the gas situation. Yeah.
Thanks very much. I'll let other people ask questions. Thanks.
Thanks, Mervyn. Next, can we have Brandon? Please go ahead to unmute yourself.
Hey, morning, Tony. Just 2 questions, right? The first one, can you update us on the refinancing cost that you did for some of the loans this quarter? At what kind of rates, and also what could we see for the MTNs that are due for the next second half of this year? Okay,
I'll leave that to Milian to explain. I think generally the spread has been relatively stable. It's only the base has been moving. I think in my earlier remark that fortunately we have been very prudent, over the last 5 to 10 years, that taking advantage on the generally very flat kind of yield curve and lock in quite long duration at a fixed rate. Now that the market has been very distorted and the yield curve is so inverted, I think we have some flexibility to look at how we want to manage the capital. I'll leave it to Milian. Yeah.
Hi, Brendan. I think in terms of the refi, we have actually completed all the refi this year. But we are looking at, we're actually in discussion with banks for new refinancing facilities for the 2023 maturities. So like what Tony mentioned, in terms of credit spreads, it's very stable. In terms of available of lines, we have actually sufficient lines to take up the 2023 debt tower. So for the recent refinancing in third Q, there was actually one refinancing that was done. That is the refi for JV debt, the 45% stake that we have in Capital Spring. So that one is a rollover for 2 years. With a group of banks. In terms of credit spread, it is actually the management team. Yeah. So there were no fixed rate debt issuance this quarter.
Yeah. Maybe I can just add on, Brandon, if you're looking at all-in costs, right? Depending on the duration and tenure that you're looking to lock in. Today the short rate is pretty high, it's very elevated. You add in all the spread, I think it's definitely north of 4%, probably aging closer to 4.5%, I would say. Yeah. And then it depends on the duration. You are looking at 2 to 3 years or looking at 5 to 10 years, right? Then you'll be slightly different. But the shorter end of the curve is very elevated for the reason everyone knows. Longer end is coming off and it's remaining fairly stable. Which means that we think that the short end will react quite quickly the moment we have some clarity where the base rate will end. Yeah.
So just a follow-up from that, right? For your hedging strategy in this market, are you looking at 50%, 75%, 100%, and are you looking to hedge 1 year swap or 3 year swap?
Really?
I think we are currently at 80. We're looking at a range of not less than 70. So between 70 to 80, that would be the kind of target range of fixed rate debt that we want to maintain. We are watching the market very closely in terms of when it's a good time to hedge. Right now, it would seem like the longer end of the yield curve makes sense. In fact, anything more than 5 years to 10 years would make sense.
Okay, just one last one on portfolio reconstitution. I think given where rates are on your cost of equity, what can we be looking at in terms of acquisitions, divestment, as well as development projects?
Yeah, I think in an environment like this, where we lack clarity, right? Certainly, prudence is the word to use. We have to be very prudent in how we look at capital deployment, and hopefully wait for more clarity on how things will settle down, because the cost of capital will just be so distorted, right, in today's environment. And if you were to undertake any kind of equity fundraise in today's market, obviously it will be a no-no. So it's something that we're watching carefully. We're definitely been prudent. We would still look at opportunity, not that we pass it. It's just a question of whether we're able to look at a opportunity that first must fit the portfolio. Second, whether it's at the right cost of capital. Yeah.
Okay, thanks. Thanks so much.
Thanks, Brandon. On capital management, we actually have a similar question from David. Question is, what is the sustainable average cost of debt in the medium term?
Really, you want to address it?
In terms of the cost of debt, when we're looking at the forecast next year, it will be closer to the level of mid-4s, even on a short-term basis, because of the curve inversion currently.
Next, can we have Rachel?
Okay. Can. Okay, just maybe a few questions. I think following up from Brandon's questions on the high interest rates, I'm just wondering whether do you still expect cap rates, any movement in cap rates by end of the year, or Singapore assets cap rates are still okay?
Yeah, okay, I hear you. A question on cap rate, right?
Yeah.
I think it will be stable in Singapore. The general market, I think general momentum has been still healthy, so we don't expect any kind of significant kind of movement or any major movement in the cap rate. If anything, it will be probably maybe some minor adjustment here and there. That's for Singapore. I think in the overseas market, we're watching potentially there could be some movement in the cap rate on the expansion side. I think we started the process of looking at the year-end valuation. The general sensing is that there could be potentially, especially in Europe, like Germany, where the valuer may start to look at a not so much a cap rate, but more on the adjustment to the discount rate, and potentially some movement or cap rate. So we're still waiting for that, but it's not unsurprising given the situation in Europe. Yeah.
Okay, got it. Maybe my next question is just on tenant sales. I mean, it's pretty strong now for this year, and it's likely going to stay quite positive for this year. I'm just wondering what's your outlook for next year? Given GST coming through, inflation, high inflation, are you still as positive of tenant sales next year? And is it sustainable?
Yeah, that's really the macro question, right? Singapore, I think overall will fare well. Next year may see a slowdown, and this is probably not in contrast to any of the outlooks. Even the MTI, they are looking at a slight slowdown next year. So I think generally there will be this kind of backdrop. There will be at the back of consumers' mind. At the moment, a few things that still seems very supportive. For example, the employment number is still looking pretty strong. We have not seen any kind of significant adjustment to the workforce in Singapore. In fact, on the contrary, I think many companies are still looking to, at most, start to taper down their hiring. But those that really need the manpower, they continue to look for talent around, not just in Singapore, but around the region, right? Around the world. So from a overall macro point of view, there'll be a bit of conflicting kind of forces. On the one hand, tight labor market, wage inflation is there. On the other hand, you see potential moving to slowdown mode. I think government policy will going to be key. How they look at navigating through this very tricky environment. A few bright spots, naturally, as a result of all the geopolitical tension you're seeing. Southeast Asia, I think, still looking pretty bright. Many companies anchored here are supporting the business expansion in Southeast Asia. So I think that's looking pretty bright. India as market beginning to look as a very viable alternative to what we're seeing in China. So that will underpin a little bit in terms of overall investment flows and potentially also the general economic velocity in this part of the world. And Singapore, I think, will tend to benefit from that. So I think there are some strong fundamentals that will help support and underpin that strong foundation moving into 2023. But nevertheless, like you mentioned, at the end of the day, the macro is the key. I think we need to see some tapering in the inflation pressure, because otherwise you will just be adding on to wage pressure. It will be a vicious cycle. So far, I think MAS has been quite clear. Inflation management is key, but at the same time, they are also careful about making sure not pricing Singapore out of competition. So in short, I would say we'll enter 2023 with a little bit of caution, but supported by some strong fundamental, and it will be a very I would say it will be quite a I don't want to use the word volatile anymore, because the market has been pricing in quite a fair bit of volatility. Hopefully, we'll see a lower level of volatility, and over time, the general nervousness about how the capital market will look like, and hence all this impact on the cost of capital will ease, and I think some normality will sink in, hopefully within the first half of the year. Yeah.
Okay, got it. Thanks, Tony. Just one last question from me. Just looking at the market conditions and at your portfolio now, do you think it's still possible to do any divestments?
Well, we certainly would not cast that off. As part of our overall strategy, we are always looking to fine tune and look at our portfolio construct. It's always in a long-term perspective. Sometimes in the short, medium term, we may react because there were interesting development, and hence we can react to it, and make capital work in a different way. So we on and off, we look at our portfolio construct, but I think we have been quite clear, in our strategy overall that Singapore will be still pretty predominant in the overall construct for foreseeable future. We want some optionality in terms of income stream, given that we are also looking at some upscaling, redevelopment potential within our portfolio that potential can create a bit of volatility in terms of cash flow income, and we need to be pragmatic. At some point, you just can't be pinning in one source of provider of opportunity. So we have been quite clear that in the mid to longer term, we need to have some variable options to look at, but the construct will still be very heavy in Singapore, given the absolute capital value to begin with is much larger than the other developed market that we have invested in. Yeah.
Okay, great. Thanks, Tony.
Yeah.
Thank you, Rachel. Next, can we have Vijay from RHB?
Hi, morning, Tony. Can you hear me?
Yes, I can hear you.
Yeah, hi, morning, Tony. I have a couple of questions. Maybe my first question is again a bit of follow-up on the acquisitions and divestments. Considering the market conditions, how does this change your acquisitions strategy in terms of portfolio deals? For example, the Mercatus portfolio. Would you, I mean, this asset, as you mentioned, Singapore is a strong market and it might be a strategic fit for your portfolio. Would you consider still pursuing these kind of acquisitions in this market, possibly via equity fundraising, or would this still, would this be a no-no at this point of time?
Yeah, so I did mention in my opening, and there's some questions that raised. I think today's market is, in today's market as in now, equity fundraise is definitely out of the question, right? It's not something we want to contemplate, and that's how we look at it from an investment perspective. Yeah. Anything more than what of course, we just have to wait for what Mercatus eventually would release. At this point in time, naturally, we know that the capital market is not ready for any kind of transaction like this.
Got it. In terms of the utility charges, you mentioned that you have secured some contracts for 2023 moving forward at a higher rate. Maybe can you give us some impact at what would be the potential impact to the bottom line based on the higher rate which you have secured for 2023 in terms of utility charges?
Yeah, so we so far year to date we are looking at about 15, close to 60% increase. I think we projected for the whole year, depending on the consumption level, we're potentially looking at close to 80-90% for this 2020 compared to 2021. Bear in mind, 2021 we end the year on a very low rate, right? Potentially we can see 2023 if nothing else change and the price stays at this elevated level, potentially another 80-90% increase in terms of the tariff rate that potentially could come into the picture. And that's where we start to look at how we kind of price in from a service charge perspective, adjustment given the different dynamics we have in the retail tenants and office tenants. I think office tenants a lot more straightforward. It's a full pass-through, and we could technically adjust from day one, which we have announced. Some of the buildings that we have adjusted. For the retail, I think we just have to be cognizant that we have a COC that we have to comply with, and then we adjust accordingly and look at the different trade sector that we are, the tenant that they are in, and their threshold, and we look at how we can moderate that over the maturity cycle. So ballpark one third will mature for retail space, and on average we're looking at about 2 to 3 years kind of time frame for us to fully price in the energy cost adjustment. Of course, along the way, if energy level drop, it's something that we have to factor in as well. But certainly we're looking at more to 2 to 3 years kind of timeline to reprice in any kind of service charge that would capture the especially the energy costs.
Okay, so just to clarify on this, the service charges is built into the part of the gross rent. So the gross rent reversions, whatever you report for retail and office, that does include the service charge adjustments, if any. Is that right?
Correct. It's just that within that gross rent, then you split, right? Because from either from prop tax perspective or from justification to tenant perspective, that's how you split the overall gross rent. Yeah.
Okay. Can you just give some, my last question is, can you just give some color in terms of Australia and German office market demand at this point of time, and especially the Arthur Street building? Do you think that you can ramp back to 90% levels which you have assumed during the acquisitions at a point of time?
Yeah, so let me touch on Australia first. I think Australia, we are, if you recall when we did the acquisition, we also had negotiated a period of time we think that we need, especially the one that the low occupancy to ramp it up. So we are still working within the 12 to 18 months time frame. So that rental support actually comes quite handy. Generally on the ground in Australia, I don't know whether you have visited before in Sydney. It's busy, on a weekday. I think the phenomenon is even clearer when people talk about the flexible work arrangement, 3 days, 2 days. I think it's even clearer in Sydney, where Friday is pretty quiet and a lot of activity is circling around Monday to Thursday. with Tuesday, Wednesday, typically very, very busy. So if you go down to Sydney, I think that's what you see on the ground. Even with our asset manager there, I think their own assessment is that this phenomenon is going to stay on for a while. That to a large extent would also in a way underpin how the office occupier looking at the space requirement. And there are some recalibration, in terms of looking at what kind of flexible work arrangement. So we're beginning to see what we see in Singapore, fair bit of those flexi space operator becoming very active now, because they are just providing more solution for the end occupier. They've been more active in the main key city like Sydney and Melbourne. So I think we expect that to continue. In Singapore, it's quite clear, over the last 12 months to 18 months in the course of the pandemic period, the flexi space operator feel a gap in the market where the needs are satisfied in a more holistic way. And their target, of course, has changed somewhat from less retail-based type of tenant, more into the enterprise type. So I think that trend was set forth in Australia as well as certainly for the CBD. In Europe, I think it's a little bit more challenging given the war situation now. I think it is not a wholesale withdrawal of occupier. What we are seeing in Frankfurt, very specifically, because you have two buildings there, is just a stalemate, right? People are not doing anything at the moment. They are concerned about the general economic outlook. They are more concerned now with the immediate issue in the winter, how they're going to deal with it. On the longer term, I think there's not much clarity. But we also think that with this issue ongoing, and at the same time, the euro financing rate is no longer zero, right? It used to be when we did the merger, the 10-year bonds was trading at minus 50 basis point. Today, I think you're looking at more than 2.5 to 2%, and they're talking about catching up with the rate hike to tame the inflation. I think that will bring a lot of discipline to the market, which has been capped by decades, more than decades of cheap or even negative interest costs, resulting in a lot of, to me, unnecessary redevelopment. So I think there will be some sanity check, but nevertheless, I think in the short term, it'll be a little bit stalemate. In the mid longer term, we see how things pan out in Europe. For us, our two building has been, I would say, relatively stable. The building in the airport side, they were supported by, in fact, quite a big revival in terms of the traffic flow out of the Frankfurt airport. So the economic activity has been picking up before the war, just before the onset of the war. With the onset of the war, the situation, I think, has flat out. I don't think it's seen a decline. They have been traveling has been still rather active, because overall, I think the concern about the pandemic has been more or less put on a back burner. I think the more immediate concern is about the energy costs. So I think the traveling part has surprisingly been quite strong. So the airport activity is okay. The only thing that we have to watch out for is the supply situation coming out from the airport location. There are a few new supply coming out, newer building, or albeit smaller kind of assets, office. A lot of hospitality link kind of building, hotels are all there. Some co-working space operating there. There's also a large building that's not far from where we are, where there's a big vacancy as a result of some downsizing, I think about 1 year ago. So we're watching the space. Nevertheless, I think we're engaging our tenants. There are some tenants that In fact, it has been flip-flopping. They wanted to return some space, and then they started to, when things pick up a little bit, they start to rethink. But now, given the uncertainty in the market, it's a little bit radio silence. So we just have to watch and see how things develop from there. But overall, I think Europe is a little bit more challenged than in Australia. Yeah.
And just one follow-up. Can you give us a physical occupancy in Singapore, Australia, and Germany at this point of time in your office assets? A broad number would do.
Sorry, the occupancy?
The physical occupancies. I mean, the occupancy, the percentage of people back in the office.
In Singapore, we are looking at on a portfolio average is about 60, mid-60s. And it varies from building to building. On the high days, it's more than 80% for some buildings. Almost as like full occupancy. As in people coming in, right? You're talking about people coming in.
Yes.
Yeah. And then some buildings we're looking at mid-4s to half 50% kind of range. But then on days like Friday or long weekend, then it's be quiet. That's normal. So portfolio, we have been trending. I've seen some stabilization. We have been trending up. I think we reported in early part of this year. In fact, last year we started reporting, looking at returning rate. Like we generally we track quite closely. It's in a way a good risk management tool for us. And we've been seeing them trending up. Now we are probably in the mid 60s. We think that we see some stabilization around there. As more and more people are returning back to office, it's probably at around that level already. Yeah.
Okay.
Yeah. And one phenomena naturally is, of course, we see also quite a fair bit of people moving in from overseas to bunk themselves in for a while to work out this location. Whether that was settled for a longer term, I think we are watching. Certainly, we get some inquiry of additional space. Given what happened, I think over the weekend, we think that the pace will probably pick up. Yeah.
Okay. Thank you. That's all I have.
Thank you, Vijay. Next, can we have Nicholas to ask your question?
Yep. Hi, Tony. Just 3 questions for me. As one is more of a follow-up from, I didn't catch what you said on the MacArthur's thing in response to Vijay. Did you say it was delayed or on hold? If not, any sense of like rough timeline on that? The other question is, when you're talking about service charge and the gross rent as a whole, from a property tax point of view, is it just the base rent that goes into the property tax calculation? In which case, if you kind of increase the service charge and the base rent comes down, is there some property tax savings for you in terms of the existing leases? And then the last question is just on utilities costs, where you said the 80 to 90% increase again. Is that 80 to 90% on the already higher utilities cost base, or is it on the 2021 level?
Yeah. So MacArthur, you just have to wait for their. I mean, I can't comment, right? As you said many times, I can't comment. Specifically for us, obviously, equity fundraising at this point in time is definitely a no-no. So, and we are very cognizant of the significant risk in terms of looking at capital cost pricing. So this is something that obviously will be weighing heavily on us, and it will definitely be one major consideration in a whole transaction, in this transaction. Yeah.
Question about the
service charge.
Service charge as part of the overall rent, and how if that increase, the base rent will come down. That will result in us having savings in property tax.
I will give some brief on how we look at it. Service charge definitely is a part and parcel of the component on any occupier. They look at it. They look at it on a total basis. But it's one element that we use it to look at how we could better manage appropriately manage the cost of running a building, and how that should be In the overseas market, you probably know that the overseas model is always full pass-through. Right? Tenant essentially covers everything. But in Singapore model, it doesn't work that way. So we try to balance out the service charge based on not just energy. I mean, it's the total cost of operating the building, right? And that just like you stay in the residential development, you pay maintenance fee, right? That it goes to essentially to manage the maintenance of your property. No different from office building or I mean commercial building. So we look at it from a pricing. The only difference is, of course, the commercial element. How much we are able to price in the overall gross rent vis-a-vis maybe the service charge. The same example I gave before. $10. Let's say existing tenant are paying $10, and within that, 150 is service charge, 850 is the rent, because you have to break that down, right? Assuming today we need 170 to be break even on managing the building, that 20 cents somehow has to be priced in this negotiation. Whether it is a 850 plus 170, or it could be just if the market is permissible, if the tenant is trading very well at a very low occupancy cost, then certainly it will not be just an 850 plus 170 we're looking at. We're looking at then the rent component will come in. So it's about communicating to the tenant how that should be looked at from the overall gross rent perspective. On the tax element, you want to touch with?
Yeah. Okay. So probably just to add on to what Tony mentioned. So actually, when of course prop tax looks at the total rent, right, including the service charge. So under IRAS, there's certain allowable items that became on the service charge. So for the retail component, right, when we adjust the service charge, then definitely there may be some kind of prop tax savings that we might get, but it wouldn't be very substantial at this point. And I think the other one, service charge with utilities. Okay, so I think the utilities actually is increased on further increase on 23 year. Further increase on year 22, not on 21. Yeah.
Okay, got it. Thanks a lot.
Thank you, Nicholas. Can we have the next question from Terence?
Hey, thanks so much for the opportunity. I just had three very, very quick questions. My first question to Mei Lian, I just wanted to clarify on her remark on the 4.5% interest rate for next year. Does that refer to the benchmark rate, or is that the average interest cost that for the total debt? Could I also ask on the second question, what's the proportion of debt in Sing dollar, Aussie, and Euro? And finally, my third question, what's the uptick? What's the reason for the uptick in gearing on a Q-on-Q basis? Thank you.
The reason for the uptick is that we did some drawdown for funding of operational requirements, working capital, in relation to CapEx funding. The interest rate mentioned earlier, it is on all-in basis, including credit spread. And then the second question is,
sorry, ask whether you have the problems in proportion in SG dollars.
Oh, sorry. Yeah, we have about 80% of our debt in denominated in Singapore dollars or have been hedged into Singapore dollars.
Okay. Sorry, just to clarify, is there any impact on the change in forex in terms of in the gearing calculation currently?
No, because for I would say that in terms of funding overseas investment, our hedge ratio is very high. Most of the funding taken was in the either Euro or Aussie dollars. So in terms of hedging ratio for overseas investments, is actually in excess of 90%.
Okay, so for the debt is 80% Sing dollar, and the proportion in Aussie and Euro.
Can I get back to you on that?
Okay, sure, no problem. Thanks.
Thank you, Terence.
That's all I have.
Yeah, Terence, maybe just to add on what Million said, I think the 4.5% is all in on today's, you go to the market and refi whatever outstanding debt. Yeah.
Okay, just so it's refinancing cost. That's not like the total average cost of debt for next year. Okay, right. Thank you. That's very helpful.
Okay. Thank you, Terence. Next, can we have Derek?
Hi, Tony and team. Can you hear me?
Yes.
Yeah, hi.
I just want to ask a few follow-up questions on interest rates and utility costs. You've done the sensitivity analysis, assuming floating rates go up by by 1 percentage point. But let's say you assume that you refinance your fixed rate loans at current rates. Where do you see DPU impact for say 2023 and 2024? Yeah, that's my. I just mentioned the other questions and on the 4.5% interest rate, is that for 3-year or 5-year fixed? And then on energy costs, Tony, you mentioned you're passing through energy costs for renewal leases on using higher service charge. What's the net DPU impact on service costs assuming you pass through to renewals? Yeah, those are my questions.
Okay, maybe I answer the last part and then I'll leave the interest one on to you. Okay, so overall, I think our coverage ratio on the energy, just alone energy, because energy is probably the biggest component in the service charge component. I think the overall operating building for this time. We're looking at coverage ratio potentially about 30-40%. Because of the lag in time, right? Like especially the retail side where you can only adjust the service charge upon the renewal or you have an expiry, and typically it's about 1/3. For the office side, I think it's pretty high. We're looking at more about 90% coverage ratio. It means for every increase in dollar, we're looking at 90 cents recovery. And we're using that on a forward basis. So we have a projected view on how the energy price level would look like, and that overall impact on the cost of the operating the building, and then we adjust it in the service charge. Yeah. So blended basically between 30-40% as of today, but gradually it should move up as and when the other leases expire. Yeah.
Well, thanks, Tony. Maybe I have to ask this way. I think last briefing you mentioned that you expect OPEX to rise by 5% because of energy costs. Is that net of your pass through in form of higher service charge? Is that already net or it's not?
When you say net off, that's only for 2022. We have not. That's only for the retail component, yes, but office no. Office we are looking at only towards next year.
I see. And then on the overall basis, I guess, well, what you expect overall OPEX to rise by in percentage terms for second half or maybe next year?
Ballpark, we don't have that. I mean, don't have that. But if I were to do a back of envelope calculation today, our OPEX expense is about energy part it's about utility in broadly utility is about 13%, about 13%, right? 13% of our OPEX. That may go up to another perhaps another 4 to 5%. Maybe we're looking at more closer to 20%. That's very ballpark. Assuming that we are able to do the pass through and some service charge recovery.
Okay, thanks, Tony.
Yeah.
Okay, thank you, Derek. Next, can we have Terence Lee?
Hi, hello. I have a question for Tony. If I look back to 2020, there was quite a bit of negative retail reversions. So since retail WALE is about 2 years and retail sales have recovered, is it then fair to say that these particular tenants are starting to be the ones driving the improving reversions going into the third quarter?
Yeah, so I think they are a mixture of both, because I think if you look at 2020, we did fair bit of adjustment on the base rent, and we also built in variable component, right? In our latest result, I think the variable rent has came in stronger than what it used to be. Today we are tracking around on the overall percentage, close to about 7.5% turnover rent coming in, compared to the typical, you're looking at about 5 to 6%. So there are some in a way compensating part when we adjust the rent down. So correspondingly, when the tenant trade better now, we are looking obviously at what will be a sustainable occupancy cost for the specific tenant and where they're getting it and how the outlook will look like, and we work yeah, including factoring the elevated costs as a result of the energy right as well. Yeah.
Okay, and second question, I see that the margins have been pretty stable on a Q-on-Q basis, despite the narrative of higher utilities costs, the 80 to 90% mentioned. So does it mean that not many of these electricity contracts have expired so far, and that most of the impact is more backloaded fourth quarter or 2023?
Yeah, the elevated, so if you recall, I don't know whether you all took note, right? In my previous briefing, I mentioned 2021, we had a very low rate, and then we extended the contract by a quarter into 2022 at a reasonably low rate. I think we lock in at elevated rate for the rest of the 9 months. So for the first half result, you will have a mixture of a lower rate and a higher rate. But the full impact will come in second half on the elevated rate because it's a new rate from April to September. So first quarter, the third quarter will result in a way reflects the full impact from the contracted elevated rate for 2022, and that will carry on to fourth quarter as well. Yeah.
Okay, because if I observe your Q-on-Q numbers, third quarter NPI margins actually look to be pretty flat Q-on-Qs, but it's okay. Maybe I'll take that question offline. Maybe another question would be, just maybe could you comment on how the 2.5% cost of debt is computed? Is it on a trailing 12 months basis? And if so, do you mind sharing what the cost of debt is for third quarter 2022 alone?
It's on a year-to-date basis. So for third quarter, we are looking at about 3.1-ish.
Okay, got it. And the last question, do you mind commenting on the Singapore office demand outlook? I think earlier in your narrative, you mentioned about how people are worried about the macro situation. So does it then trickle down to you expecting slower rent growth ahead?
So we have filled up quite a fair bit. I mean, we can only talk about our own portfolio generally, right? So I think we have filled up quite a fair bit. What's remained is the Capital Tower. I think the bigger component, the remaining part of JPM space. We've seen in fact the healthy inquiry, and we are already at different stage of either documentation or negotiation. So that number should trend up overall. In terms of how we posture, we are definitely posturing on a higher rent. Even Cap Tower used to be looking at below it's a single digit number, right? Today we're looking at a double digit rent ask for Cap Tower. And for the rest of the year and looking to next year, I think the demand, my own prediction is that I think the demand will still be reasonably healthy. Some of the big name tech company may want to recalibrate how they want to look at their space requirement given the macro outlook. And of course, there are some disruption in some sector of the new economy. I know things like the crypto market, I think it's pretty weak. Unfortunately, we don't have that. But we also seen a overall, although may not impact us so much, really strong family offices set up here, and this is reported widely, right, in different various media or the consultant report. Those will take up space. So it's about getting the level where the vacancy is at a nice equilibrium. I think then I think the market rent is probably be sustained, because I think the supply situation is very manageable. The big supply coming up as of is in the market now is naturally the bigger one is like Gogo Midpoint Tower, and the later on in 2024 or early 25, they're looking at the One Central Boulevard. So these two are the more significant coming on the market, and it's already been reported in the market that some transaction has already happened. So I think the big question mark is really how the big tech company are going to, because they are the one that's been taking up a lot of space. Some banks are still looking at right-sizing their business. Generally, no different from pre-COVID. There are new demand coming in from various industries. Business support industries are also looking at Singapore as an interesting location. So I think there will be the demand dynamics that would come in different pockets of time. So it's a question sometimes to me, you may see some noises in the market in terms of vacancy and transacted rate, right? That could be a function of when the demands really come in, at which point in time, when the supply and where the grey market surface, there will be some adjustment. There'll still be corporate who are adjusting to different model, and then how that demand supply can fulfill at different point in time. At the same time, we're also watching closely. I think at the moment, the healthy environment we earlier talked about in the co-working space, I think it should play well in today's climate, given the uncertainty. So it will be underpinned. I think we're watching even our own space. Cap Spring, as probably I think I mentioned before, is very well filled up. We are starting to introduce 6 Battery Road, the how many floors? 2 or 3 floors. 2 to 3 floors space coming out the market. We're seeing some traction as well. So those will be the one that will be filling up space requirement for generally, I think, a smaller occupier. So it could potentially be family offices. It could be also potentially be new setup here, and it could be also potentially for temporary needs for company who are adjusting their operational requirement as a result of their repositioning, how they want to put their resources. So I think that will fit in quite nicely. Yeah.
Okay, thanks, Tony.
Thank you, Terence. Next, can we circle back to Derek? I think we missed 2 of your questions earlier. Would you like to ask again?
Yes, hi. Yeah, the 2 questions were on interest rates. You put out that sensitivity impact on floating, but assuming you refinance your fixed rate loans at current rates, what is the DPU impact for say 2023 or 2024?
I think this question is,
Terence, Derek, we can't give forecast.
Yes.
Yeah, so I think what we have shared is it's really just based on if in today's market, this is the type of rates that we expect to get. That's it. So it's a hypothetical question.
Okay, sure. And on just that 4.5% interest rate, is that for 3-year or is it 5-year fixed?
It is for tenor that's longer than 5 years.
So what's tenure again?
And then the other question from Terence on the percentage of debt in the other currency. So we have about 40% in Australian dollars, 11% in euro dollars. And the balance will be in Sing dollars.
Thanks, Megan. I hope that answers your question, Derek and Terence. Next, we have another question from Marvin. Please go ahead.
Hi, Tony. This is a question from clients have been asking me. In terms of MPR for third quarter was 273 million. If you adjust for straight lining, what would the cash MPI be in terms of year-on-year growth in terms of cash MPI?
Yeah, number. Can we come back on that?
Sure, no problem. Just on Raffles City, I think a lot of repositioning. Can you talk about the occupancy levels that you're seeing for the property, rental reversions, asking rents? I don't know whether semi-luxury will do better next year. I don't know, but how are you seeing things for Raffles City?
I think overall the positioning is as what we planned for. We wanted to anchor Raffles City as a major center for the beauty related trade, right? So the beauty cluster will be one key anchor. So we executed that. So level one, look at it. I think if you have a chance, we probably can take a look. Some of the names are certainly very interesting. So you'll be a one-stop shop. These tend to be high trading business, ticket-wise as well as margin. So those are in our view an area that we want to tap strongly, because you no longer just cater for our local needs. I think you will cater to business travelers, tourists, who may reside around the City Hall location. So I think we are anchoring that positioning. Overall, based on the AI space that we have carved out, I think the demand has been healthy. Today we are looking at about 70% of our space already either operating or locked in or at different stage of documentation and negotiation. The latest that opened up is Uniqlo. I think it's I don't know whether you have a chance to see, but it's opened up already. But overall, I think the Raffles City is positioned such that we want to anchor a little bit on the consumer that has got higher dollar value spent, in terms of the pocket size, the ticket size. On your question whether that would be a challenge, on the contrary, I think that's something we are rethinking about how your portfolio construct should look like. As you probably know, Singapore is moving higher and higher in the value add chain. The consumer market generally would move up the value chain as well, given the kind of people that we are attracting here in Singapore. We only have one property, Raffles City, that we can bank down on to make sure that we position it right. City Hall location is pretty good. It's an alternative to Orchard Road. It's got a healthy cluster of hotel that cater to the needs, whether people are traveling here for business, for the conventions, or tourists who are here because this is also a location that's close proximity to the Pacific District. Right? So I think from a location perspective, we have pretty clear. But we also know very well we probably not be able to take on the likes of MBS, where they are on the ultra lux, right? The super tier 1 kind of luxury brand. So we are not in that category. So we want to find a sweet spot. We hope that this is a sweet spot we can attain for Raffles City. Generally, Singapore is attracting more affluent kind of travelers. Hopefully, this will be the mid-high end market that we are able to attract as a result. Not just our own Singapore residents, but also people are traveling here or future residents that may reside in Singapore. Yeah.
Just one final question for me. With the borrowing costs, new financing costs at 4.5%, there'll be likely negative carry for that debt for the office portfolio. how are we thinking about interest coverage ratios into next year? Is there any scenarios whereby it drops below 2.5%? Yeah.
Based on our simulation, I think the buffer is pretty high in terms of the interest coverage ratio. So at this stage, no, you'll still be above 2.5 times.
Okay, to give some comfort, this is what I thought. I think there'll be other REITs who have bigger problems, I think.
I think we have done a fair bit of stress testing in our own portfolio. Yeah. At this point in time, I think we are still okay.
Okay, thanks very much. I think it demonstrated the portfolio resistance, all the good work it done in terms of hedging for the last 5-7 years. It's starting to pay off. I think other people a bit more aggressive will probably suffer going forward. Yeah.
Thanks, Terence. Thanks, Melvin. Sorry.
Thanks, Melvin.
Yeah. Too many Terrences these days. But there's only one important Terence from JP Morgan.
Oops. Okay.
Okay, I'm mindful of time. We'll just take one last question from the chat from Rachel. So she's asking if you can share any color on the occupancy at WeWork for 21 Collyer Quay.
We only know what's reported, right? They actually reported very high 90s on the first phase that they launched in that was in August, right? In August, yeah. So I think that's a healthy start. I don't think we can comment on how their occupancy level is, but if you were to look at general direction, they certainly would fulfill a certain needs in the market. So I'm pretty confident that I think they will be able to gain some traction. Yeah.
Okay, thank you everyone. That's all the time we have. If you have any further questions, please feel free to reach out to the IR team. Otherwise, we hope you have a good week ahead. Thank you very much.
Thank you.
Thank you.
Thank you. Bye-bye.